Very good morning, friends. In our today's session, we will start on the topic on ratio analysis. Now, friends, what is ratio analysis? Why we are studying? What does it do, or how it helps to the organization, to the investor, to the creditor, or to the business proprietors, etc. Study a basic on it. Ratio analysis, friends, it is a analysis or a comparison or a relationship between two interrelated variables. Okay, so it is the analysis of financial statements, a comparison. It helps us in interpreting the financial results. It also provides us it also provides us a necessary information to the management to take a quick and a prompt decision at the right time, at a right decision relating to the business. It also helps the management for effectively discharging their duties like planning, organizing, controlling, staffing, directing, and forecasting. Meantime also it helps to the investors, the creditors, the proprietors, the other parties. How it helps? By it, it is also an effective mean of communication and information about the financial soundness, how well the business is performing in the market as a whole. These are the main things which ratio analysis gives us or provides us, so that we can aim at ultimate aim was it to is the decision making. So our decision should be at the right time, quick decision, right decision should be there. For that, ratio analysis helps us, be it for management, be it for proprietor, investor, creditor. It helps us to determine the performance of a liquidity, solvency, profitability, the credibility position of the business concern. Ratio is an important method or a technique to determine the performance of financial strength and weakness of a respective firm. So now, friends, ratios, what is there? Ratios are broadly classified into three categories. Listen carefully. Ratios are broadly classified into three categories. The first category is your classification based on balance sheet. The second would be a classification on the basis of your profit and loss account or income statement or revenue statement. Your third classification would be your mix-up of A and B, that is your mixed statement known as balance sheet and profit and loss account. Further subclassification group is, there are mainly 5 ratios. The first is liquidity ratio, profitability ratio, solvency ratio, turnover ratio, and your overall profitability ratios. So today in our session we will start a ratio analysis problem classified on the basis of income or let's say revenue statements. So these ratios, what is income statement ratio or let's say revenue statements, what is this classification, what is come under this classification is, mainly this classification or this ratio deals with the relationship between two items or let's say two group of items of income statement or profit and loss account, with gross profit ratio, net profit ratio, expenses ratio, operating ratio, etc. Let's give an example, friend, before we wind up this introduction session on ratio analysis. We will take an example of inventory, a stock turnover ratio. Like what does it mean, inventory, how it helps, etc. Inventory turnover ratio means it is measuring the number of times an inventory is turned over, or let's say in a simple language was converted to sales during a specified year or a period. It may also called as a cost of sales to inventory ratio. It's a comparison as a cost of sales to the inventory ratio. It is a good indication of let's say it's a good indication of efficiency or the production efficiency or purchasing efficiency in terms of management. In general words, we can say as higher the inventory turnover ratio, the more frequently the inventory is turned on or turned over or converted to sales. And conversely, a less turnover ratio is the vice versa. Less turnover ratio, let's say lower turnover ratio is mainly in furniture store, etc. You might expect a company with a perishable inventory like grocery store is there to have a very high inventory turnover ratio, and conversely a furniture store is there or a furniture company is there. they might have a low turnover ratio or low inventory turnover ratio. So in our next slide, we will study on a problem related to the income statement or revenue statement or profit and loss account. On the basis of the problem, we will start a solution. Yes, friends. So we will start with the problem. The following is the trading and profit and loss account of a company named Fantasy Limited for the year 31 March 2000 is given below. So we will read out the trading account debit side first. In the particular side, to opening stock is 76,250, to purchases is 3,15,250, to carriage and freight is 2,000, to wages is 5,000. We start with the credit side of trading account. By sales is 5 lakh. By closing stock is 98,500. So your gross profit brought down in debit side will be 2 lakhs, and the total amount of debit and credit side of trading account is 5,98,500. We'll start with the profit and loss account or the income statement. In debit side, to administrative expenses, that is your office and administration expenses, is 1,01,000. To selling and distributive expenses is 12,000. To non-operating expenses 2,000. To financial expenses 7,000. Start with the credit side of profit and loss account. By gross profit brought down, that is 2 lakhs. By non-operating income, under non-operating income there are three non-operating incomes. They are interest on securities 1,500, dividend on shares 3,750, profit on sale of shares is 750. Your net profit carried down in debit side is 84,000. So the total amount of income statement of profit and loss account is 2,06,000. So the question here is to calculate 6 ratios, namely gross profit ratio, expenses ratio, operating ratio, net profit ratio, operating income net profit ratio, and your last is your stock turnover ratio or your inventory turnover ratio. Remember friends, in the previous slide I have just said we will start ratio analysis classified on the basis of income statement or revenue statement or profit and loss accounts. So these are the main ratios under revenue statement or profit and loss account on the classification. The sub classifications are these. So we will start with the solution. So friends, for the solution, we will start with the first ratio to calculate is gross profit margin or gross profit ratio. Remember, where profit is there, naturally in the formula sales would be there. So how we are getting the profit? By selling a product or by selling anything, we are getting a profit. First we will get the break even, then we will get the profit. So for gross profit margin, the formula is gross profit divided by sales multiplied by 100. So what is your gross profit? The gross profit in the trading account you can see in debit side, that is 2 lakhs. So 2 lakhs divided by sales. So what are your sales? What is the amount of sale? That is your 5 lakh. You can see in the trading account credit side by sales, that is 5 lakhs. So 2 lakhs divided by 5 lakhs multiplied by 100 to get percentage. So 40% is your gross. Then we'll start with this second ratio to calculate, that is expenses ratio. And expenses ratio, remember the formula will be all your operating expenses divided by your net sales multiplied by 100. So what are the operating expenses, friend? You can see in the profit and loss account debit side, operating expense, there are two operating expenses are there, that is your operating office and administrative expenses 1,01,000, selling and distributive expenses 12,000. So these are the two operating expenses. So 1,01,000 plus 12,000 is equal to 1,13,000. That is your operating expenses divided by your net sales. You can see in the trading account credit side by sales 5 lakhs. So 1,13,000 divided by 5 lakhs multiplied by 100 to get percentage is equal to 22.60%. Then friends, your third ratio to calculate is your operating ratio. Operating ratio, the formula is cost of goods sold, COGS, plus your operating expenses divided by net sales multiplied by 100. So your cost of goods sold, and the cost of goods sold, there is a formula. Opening stock plus your purchases plus your carriage and freight plus your wages. In the trading account debit side you can see the amounts less your closing stock, which is in the trading account credit side. So what is your opening stock amount? 76,250 plus 2 purchases, that is also you should add for COGS. Purchases is 3,15,250, carriage and freight 2,000 plus your wages 5,000. This all you have to add minus your closing stock amount, that is 98,500. So you will get 3 lakhs as COGS, cost of goods sold, plus your operating expense, which we have just discussed in the previous slide for expenses ratio. Operating expenses are here. Administrative expense 1,01,000 and your selling and distributive expense 12,000. Together will be 1,13,000 operating expenses. Divided by your net sales, which is in the credit side of trading account, 5 lakhs. 3 lakh plus 1,13,000 divided by 5 lakh multiplied by 100 is equal to 82.60%. Is your operating ratio. Then friends, your fourth ratio to calculate is your net profit ratio. To calculate the net profit ratio, the formula is net profit divided by net sales multiplied by 100, which is equal to net profit. So what is your net profit? You can see in the profit and loss account debit side. Below is net profit carried down. So how much, what is the amount? It's 84,000. Just write the 84,000 net profit divided by your net sales. In trading account credit side you can see sales is 5 lakh. So 84,000 divided by 5 lakh multiplied by 100, you will get 16.8% as your net. So friends, we will start with the fifth ratio. This is your operating profit ratio. In operating profit ratio, the formula is operating profit divided by your net sales multiplied by 100. How to calculate your operating profit? Operating profit is equal to sales minus, in the whole bracket, operating expense plus your administrative expense. What is the amount of sales? That is your 5 lakhs, which is written in the trading account credit side. 5 lakhs minus your operating expense. Remember friends, operating expense we have just calculated. That is in your third ratio, operating ratio. COGS plus your operating expense. 3 lakhs plus 1,13,000, that is 4,13,000. So we will just write there 4,13,000. So sales is 5 lakh minus your 4,13,000 is equal to 87,000. 87,000 is your operating profit divided by net sales is 5 lakhs multiplied by 100. You will get an answer 17.40% as your operating profit. Then the last ratio to calculate is your inventory turnover ratio, also known as your stock turnover ratio. So friends, and stock turnover ratio, the formula is your COGS, cost of goods sold, which we had already calculated, divided by your average stock, that is your opening stock plus your closing stock divided by 2. We will start solution. Cost of goods sold. We have calculated cost of goods sold. So what we have added to opening stock, we have added 76,250 plus your purchases also we have added 3,15,250 plus your carriage and freight we had added 2,000 plus wages 5,000 minus your closing stock 98,500. We will get cost of goods sold as 3 lakhs divided by average stock, that is opening stock 76,250 plus your closing stock 98,500 divided by 2, you will get 87,375. So we will write the amount 3 lakh in cost of goods sold in numerator divided by denominator, write as 87,375. So get the answer as 3.43. 3.43 means inventory turnover ratio is a 3.43. It measures the number of times, that is 3.43 times inventory has been turned over, or in a simple language was converted to sales during a specified time period. Okay friends, so as I earlier stated in the ratio analysis introduction topic, in general we can say as higher the ratio, the more frequently the inventory has been turned over or the company is well performing. And conversely, it's a and vice versa, that is conversely, low inventory turnover ratio if it's there, that means the company is lacking in their production efficiency or their purchasing efficiency. Thank you.